Let's dive into some price action patterns that I often use in my trades. I'm going to cover some essential concepts like the momentum correction wave pattern, which is obviously a trending pattern that aims to improve your timing when placing a trade in anticipation of a trend or reversal in the market. And of course, I'll walk you through how to identify this pattern and other common patterns that show up frequently in the market as trends unfold. And by the way, it doesn't matter if you trade futures, options, cryptos, whatever. These patterns, when interpreted correctly, can actually offer solid trading signals. So let's get into the charts and take a closer look at this momentum correction wave pattern that caught my attention recently and discuss the main factors that may have contributed to its formation. As you can see from the chart, the market initially experienced a strong uptrend here before reversing direction and dumping through this sequence of impulsive supply bars, which typically represent the dominant force in the market. Now I call this sequence and the rest of the decline the momentum phase, since it is marked by the price reversing rapidly against the prevailing trend. Following the momentum phase is a corrective phase, which can be a retracement against the current trend. During this phase, prices may initially move in a sideways fashion and then retrace a part of the impulsive move. It's worth noting here that the interplay between the momentum phase and corrective phase can manifest in different ways. However, for this pattern to work, the momentum phase should be more extended than the corrective phase and shouldn't surpass the momentum phase highs. And this is important to remember. Also, traders using the MC wave pattern should look for opportunities to enter trades in the direction of the impulsive sequence, which is bearish in this case, once corrective phase 2 starts. What that means is that if I wanted to capitalize on this particular price action, I would enter a short position upon a retracement to a key level, such as this support zone within momentum phase 2. Why? Well, because notice how the support level linking the MC wave pattern experiences a decisive breakdown with a supply bar closing well below it. This breach and close indicate, in my view, a bearish trend continuation, presenting an opportunity to enter a short position. Obviously, the stop loss should be placed above the swing high here. I would also like to note that you could also look for other chart patterns within the corrective phase, such as rising wedges, bearish pennants, or descending channels that indicate a potential continuation of the impulsive move. Once you identify them, then you can use them as confluence of the momentum correction wave pattern. Now let's talk about imbalance zones and a concept I refer to as a supply or demand imbalance ripple, which depends on the direction of the market trend. This is a key price action pattern that is observable across various markets and time frames. If you are new to day trading, an imbalance is basically recognized through a 3 candlestick sequence where the low of the first candle does not overlap with the high of the third candle or vice versa. This non-overlapping pattern makes or designates these areas as imbalance zones, which are also called inefficiency areas. So if you hear someone saying, well, this inefficiency is so and so, well, basically they are simply referring to an imbalance zone. Now, although imbalance zones and supply and demand zones are not the same, they are often seen as key components of the supply or demand imbalance ripple strategies. The concept is basically based on the idea of locating, in this case, a supply zone marked by an impulse move and price acceleration to the downside that creates an imbalance zone. What that means is that following this strong market sell-off, traders often anticipate, and sometimes it works and sometimes it doesn't. Nothing in trading is obviously guaranteed. That's why we have stop losses, but retail traders often anticipate a market reversal to the upside to balance this imbalance zone. And again, the underlying principle here is the market's tendency to often restore a price equilibrium, which is basically its primary mechanism to achieve balance between supply and demand forces. So after the market rebounds from the lows here and rises within the imbalance zone without breaking through the resistance level of the supply zone, there is a likelihood that if the base or support of the supply zone is breached to the downside, the market will begin to head south. This situation indicates that considering a short entry at this point would be a logical decision. Similarly, you can apply the same trading logic to the demand imbalance ripple concept, but this time focusing on the long side of the market. In other words, once the market reverses from the highs and declines within the demand zone without surpassing the support level of the zone, which was created as a result of this explosive impulsive move here, there is a possibility that if the resistance level of the demand zone is breached to the upside, as is in this case, the market will begin to trend higher. In this situation, going long would be the right approach. So the idea here, guys, is to use imbalances as additional confluence for your other trading signals. Next, let's analyze this 4-hour chart, ES chart that is, which by looking at it shows not only the unpredictable nature of trading, but also how to navigate the market's fluctuations. Now, in every trade I consider, I always start with a trade checklist. At the top of that list is identifying key value areas such as support and resistance levels. You can do this by simply spotting the major swings in the market. Based on these swings, it's obvious that we have a support area down here and a resistance area up here. Next on the list is the reversal catalyst. This can be an inverted head and shoulders pattern, a double top, a series of higher lows or lower highs, rejection wicks, triple bottoms, and so on. In this particular case, after the market broke through support, it began to form a bottom, effectively halting this 120 points nosedive with this double bottom formation. However, the presence of this double bottom pattern combined with a strong rejection demand bar does not automatically confirm a shift in the market's bias to the upside, especially when the formation of this upper wick here completes this descending trend line, suggesting the potential for more selling pressure. Certainly, such conflicting signals create a mixed picture of the market's true bias. As I mentioned earlier in the video, it's crucial not to enter a trade solely based on a single pattern. Confluence, which is the third step on my list, must be a part of your strategy. And that's why my thinking here is that as long as we manage to break above the trend line initially, followed by a clear move above the 4810 level, which is the level where the market breaks its current formation or structure, the bias screams, in my view, north. And here we have, as you can see, this nice strong break above the descending trend line and the structural level, a clear signal that buyers are stepping in, overpowering the bears and confirming the start of a bullish reversal. So this is your entry point. Obviously, each trade is unique and not directly tied to the previous one based on specific price patterns. However, your emotions, when managed effectively, can actually create a connection between your trades, and this can lead to improved trading results over time. So to recap our multi-step strategy, first we identify key value areas in the chart that represent significant levels of support and resistance. Then we patiently wait for the right combination of reversal catalysts to emerge. Last but not least, we see confluence among the signals to confirm the bias of the reversal. This approach, in my view, not only increases the probability of green trades, but also helps you navigate the complexities of the market with more clarity. And if you are interested in a deeper dive into my strategies and trades, make sure to watch this video right here. Alright gang, that should do it for today. Thanks for watching, and as always, hope to catch you all in the next one.